easing into the new role. Of course, I've been with the company already for many years, which helps things. Before being promoted to CEO, I was 8 years CFO of d'Amico International Shipping, and therefore that means that I also shared a lot of the decisions which were made in the last few years. Paolo D'Amico, who was CEO before me, who is still very much involved with the company as in his new role as chairman. So the company is being managed in continuity with the past. But of course, taking into account the rapidly changing environment in which we operate, which is of course posing a lot of challenges, but also offering a lot of opportunities to us.
So it's been a year more or less since the last time we talked, and how would you sum up the year that has passed?
Well, it has been a very successful year for the company. I think the net profits from a financial perspective kind of give a good idea of the achievements. And we had in the first 9 months of the year profits of 163 million. Which is well above the 149 million recorded during the same period last year. And it is also the highest ever net profits recorded over the first 9 months of the year for the company. The last quarter was not as strong, but was still very profitable. And so we had a very good 2024. It was a year where we were also quite active in renewing our fleet. We sold our oldest vessel, the Glenda Melanie, for a good price by historical standards, over $27 million. We also ordered 4 LR1s at new Yangtze Shipbuilding that will be delivered to us in the second half of 2027. And we exercised purchase options on 4 MR vessels, 2 which were already delivered to us and 2 which will be delivered next year. But notwithstanding these investments, we generated so much cash last year that if we look at the calendar year, we paid generous dividends of $16 million, final dividend out of the 23 results in early May, and then an interim dividend of also another $30 million at the end of November. And we also were quite active on the share buyback front last year. We continued investing to increase also the efficiency of the vessels that are on the water by installing energy-saving devices and by taking operational measures which make them more efficient. So, of course, all of this was done whilst confronting a very challenging geopolitical environment, which created many inefficiencies, which contributed to the very strong spot markets and period markets we saw last year.
Comparing the situation today with the situation back then, are you more excited now about the outlook?
Well, we did have a softening in the market in the second half of the year. But since then, the market recovered. I would say in the beginning of this year, this recovery has only just started, but it has been quite strong. The last 10 days or so, we have seen the market moved up very convincingly. across all regions. It was expected that this would happen. There was some very specific reasons why the market started weakening from July last year. Some analysts, myself also, expected this recovery possibly to have happened sooner. Already in December, we were expecting stronger markets. December was not a great month. It was quite strong in the Atlantic basin, but very weak east of Suez. But now, once again, we are seeing most regions really moving up very convincingly, and I think that the outlook is very good for the first half of the year at least.
In your intro, you mentioned new builds and you mentioned options exercised. Can you comment a bit about how well timed were these actions? Are these in the money now, or how does it look?
Yeah, they are very much in the money relative to the peaks in the second-hand prices reached towards the middle of last year. Values have softened a bit, but they're still very high by historical standards, reflecting the very strong outlook for the market. And so the vessels we exercised, they were modern MRs, eco MRs built in 17 and 18. So the average age of the vessels we have on the water that we own is around 9 years. So by exercising these options, we are actually, these vessels are slightly younger than the average age of our fleet. So we are modernizing our fleet. We're gaining control of good assets. These vessels were built at good Japanese shipyards. But also it allows us to manage them technically according to our standards, to implement some improvements, install energy-saving devices, make these vessels more efficient, and commercially more attractive, and I believe also lengthen their useful life. So we are quite happy to have gained control of these vessels. When we bought them, the prices we paid were between 25 and 30% below their market values at the time, but they're still very much in the money.
Great. Can you comment a bit on the different vessels in your fleet? Which vessel types have performed the best so far, and what are your expectations for 2025?
Yeah, we had the yellow ones performed brilliantly, especially in the first half of the year. And I must say we made a good decision in that respect, because towards the end of 23, we had a few contracts terminating for period contracts for LL1s, and we could have renewed them at good rates, but which we felt did not reflect the earnings potential of these vessels. And we decided to keep them on the spot market instead. We decided instead to take more coverage on our handy-size vessels. So we had, for most of last year, all of our handies covered through time charter contracts. But we had 4 LR1s on the spot market. Now we have a 5th one coming to the spot market soon. And despite the weakening in the second half of the year, the rates that we were able to earn, the average rates over the year on the other ones, I cannot give specific values because we still haven't approved our financials, but they were higher, much higher than what we would have achieved if we had fixed them on time charter at the end of 2023 for 1 or 2 year periods. We did also well by fixing the handy-size vessels. In that case, I think we did better through the period contracts we had than if we had operated the vessels on the spot market. We had a more balanced coverage percentage for the MRs, which of course also performed very well last year.
Have the recent events and the turbulence we've seen, has it affected your thinking in terms of contract coverage?
Well, it was always our intention to increase slightly our coverage for 25. And when we approved our Q3 results, our coverage was for 25 at 25%. And our objective is we mentioned at the time already, was to increase this coverage to around 40% for 2025. And we are working on that, and hopefully we'll be able to announce soon some new contracts. We will also try to increase slightly the coverage for 26. We believe the markets have still very strong fundamentals, but of course the market is driven by many geopolitical events which are well beyond our control, and there are some of these geopolitical situations can evolve favorably for us, but others can evolve negatively for us. And therefore, we feel that slightly increasing our coverage, if we can achieve good rates, is the right thing to do at this point in the cycle.
You like to highlight the percentage of eco vessels in your fleet, and what are the benefits we can expect from this going forward?
Yeah, no, the eco vessels, I mean, we did invest a lot between taking vessels for vessels which were delivered to us between 14 and 19, 22 new buildings. And thanks to that, we now have quite a high percentage of eco vessels on our fleet. This percentage was as low as 38% in 2019, and we are now around 85%. And this percentage should continue rising in the coming years as we dispose of our older vessels and we take deliveries of the LR1s. These eco vessels can consume between 25% and 30% less than conventional fuel vessels. Than conventional vessels, not conventional fuel vessels, which at today's bunker prices translate in savings on a TC equivalent basis of between $2,000 and $2,500 per day. But we are confronting a regulatory environment which is becoming stricter by the day and penalizing the more polluting vessels. I'm referring, for example, to the EU ETS and the Fuel EU. The EU ETS is being phased in, and as it is being phased in, we are going to have to pay more for the CO2 emissions for voyages that touch European ports. And the Fuel EU is more focused on the greenhouse gas intensity of the fuels burnt, but it will also favor less polluting vessels. And there's also talk of a carbon tax being imposed by the IMO, and that eventually might happen. And therefore, having efficient vessels, which is already an important advantage today, will be an even more important competitive advantage going forward.
We already discussed a bit your country coverage and your plans there, and you also mentioned that there are a lot of geopolitical events going on these days, and they can benefit you or they can hurt you. And my question is, how resistant are you now to if we should see weaker markets again?
Yeah, no, we are resistant because we have a very strong balance sheet in the first place. I mean, the ratio between our net financial position and our fleet market value as at the end of Q3 was of just over 6%. We have been lowering our break-even over the last few years, cash break-even, P&L break-even, by deleveraging our balance sheet, by exercising the options on these TC-in vessels and these bareboat chartered-in vessels. And we have some good level of contract coverage below where we want to be, but it already provides some ballast to us, what we have. We have locked in profits for next year of almost, let's say, $30 million, assuming we can at least break even on the remaining open days, not covered days. And we have a sensitivity for every $1,000 per day change in the TC equivalent rate of 8.5 million, which, if we are able to increase our coverage to 40%, would reduce our sensitivity to $7 million. So we are quite confident that even in a drastic scenario that we do not envisage, we would have a very good 2025 from a financial perspective.
Let's look a bit at recent events. I mean, there's a lot going on these days, and we've seen recently reported that many ships have anchored, and we've also seen that China and India are trying not to get off on a bad foot with the new Trump administration. And we are used to hearing about China, or at least India, both of them actually taking advantage of the situation. So, I mean, how does this look from your side? What's changed?
Yeah, I think that there was a phase-in also of these sanctions, right? Because during a long period, inflation was a very big concern for the US and for European countries. It is much less of a concern today. We see that inflation figures are moving in the right direction. There was a concern that there could be a scarcity of oil that could have led to a sharp increase in oil prices. And there were also elections which had to take place in the US this year. And we know how the oil price is important from that perspective. But these sanctions, which were imposed in, let's say, a rather soft manner to start off with, can become much more stringent. And today, we have a much bigger surplus of oil in the market than we had a few years ago. Non-OPEC countries continued ramping up oil production, forcing OPEC to cut production to balance the market. So we have a lot of spare supply. And it doesn't surprise me that both the EU, the UK, and the US are taking now a much tougher stance in relation to vessels which have been transporting sanctioned cargoes. In the case of Russia, not respecting the price cap. In particular, the OPEC sanctions are very effective. We saw that of the vessels which had been sanctioned previously, in October 23, 39 tankers, since these sanctions were imposed, 33 of these vessels failed to lift cargoes. And so the sharp increase in the number of tankers sanctioned by OFAC recently to 160 vessels will have a very important impact in the market because it's going to be very difficult for these vessels to continue operating. The Shandong Port Group already announced that they are not going to be receiving sanctioned vessels. And the same might happen in India. And so what we are probably going to be seeing is if these vessels do continue operating, they're going to be doing ship-to-ship transfers, which is highly inefficient. Some will stop operating altogether. Hopefully, this will be effective in penalizing even more Russia, and also it will strengthen the negotiating position of Ukraine when we approach the moment of negotiating a peace deal. So the sanctions are also much wider than they were previously. They affect insurance company, oil service companies. So they will hopefully also hinder the ability of Russia longer term to continue producing the same quantity of oil. So I think these sanctions are very meaningful, and they're going to be very impactful also from a shipping perspective.
The crude tankers have got a lot of attention over this in recent weeks. And why should we look at product tankers now? I mean, we've even seen that recently analysts have cut price targets on various product tankers. So, I mean, why should we look at the product tankers at this point?
Yeah, no, it is true what you're saying, and I have been actually quite bullish on the VLCCs for some time, especially because the order book there is extremely limited. Only 6 vessels are going to be delivered next year. And so with minimal scrapping, we could actually have negative fleet growth for the VLCCs next year. There's also a lot of new oil which is going to be coming to the market from non-OPEC countries, as I just mentioned. A lot of that is going to be produced in the US, in Canada, in Guyana, in Brazil. And so if a good portion, as usually happens, of those incremental barrels are exported to Asia, then they will be transported over quite long distances, and they'll be contributing a lot to the ton-mile demand for crude tankers, and in particular for VLCCs. So this is a segment which has underperformed over the last few years, but I think it is going to be doing very well this year and the following year. It's also important to remember, however, that the crude tanker market is much bigger than the product tanker market. So if you look at on a deadweight ton basis, 71% of the overall tanker capacity is composed of crude tankers. And therefore, what happens in the crude tanker market is very important for the product tanker sector. And we saw that this summer, where there was a large amount of clean petroleum products transported on Suezmaxes, but also, and this is highly unusual, on VLCCs, which cleaned up to transport these products. I have talked with a few traders, oil majors, which were involved in these trades. Not all of them want to continue doing this. Some of these transactions didn't go that well. It is quite challenging to clean a VLCC, very inefficient, very time consuming. very expensive. And so especially on the VLCC front, if we have strong markets next year, we are not going to be seeing these cleanups during the summer. We might see some Suezmaxes continue to support clean products, but to a lesser extent than we saw last year. So that in itself will tighten the clean product tanker market and will support the product tanker market. So I think that in addition to all the other factors which the product tanker market is benefiting, will ensure we have strong product tanker markets also this year and hopefully also next year.
On the crude side, I mean, this has been anticipated for a long time. You know, people have been waiting for these sanctions to take effect, and now it seems it's happening. And if we look at on the product side, I mean, what kind of event or what do we need to see before we kind of see a change in attitude and expectation towards your segment?
Well, I think the earnings, the results, I think that investors will come back and they will buy our shares when the earnings of our vessels increase. And today we operate in quite a transparent market. So, and I meet investors regularly. There are more and more investors who are quite sophisticated. Some of them have their own models. They really analyze the market quite thoroughly. They follow the market very closely. And so when they see, the earnings of product tankers going up, they see that it is sustainable. They are going to start buying shares of product tanker companies again. And we are already seeing that to some extent. I mean, last year, product tanker stocks didn't perform well. But this year, we have seen that they're all already up quite a bit since the beginning of the year. And there's probably more to come if the markets continue being strong.
If we look at 2025, can we conclude that crude will outperform product?
Well, crude should do very well for the reasons we mentioned, in particular the VLCCs, the Aframaxes and the Suezmaxes have already been doing quite well over the last few years. So I would say that the VLCC is the segment that will improve most, but that product tankers will also do very well.
We spoke with one of your competitors in December, and they talked about diesel imports to Europe, and they talked about rates being on fire. And can you tell us a bit about what's going on here and how important it is in the big picture?
Rates have definitely moved up a lot. During the summer last year, there was a lot of diesel and jet which moved to Europe, also on crude tankers, which had been cleaned up. That did create a bit of an overhang of stocks, in particular of gas oil in Europe, where industrial activity was not as strong as anticipated, in particular in Germany and in France. And so it created a mini inventory cycle. These stocks had to be digested before demand returned, and that is one of the reasons the market was not that strong in the second half of last year. But as these stocks have been or are being digested, the demand is coming back. Also, refineries in the Middle East did stop for maintenance towards the end of last year. Now they are coming back from maintenance, and we are seeing a much more dynamic market in the Middle East. We first saw more product moving within the Asian market from the Middle East, but now we are also seeing again the long haul trades coming back from Middle East to Europe, and that is very important. Those are the trades which are very rich in ton miles, and which keep these vessels occupied during a very long time. And so they should support a strong market, I would say, at least for the next 6 months.
We've got used to hearing that ton miles are increasing, and is this something that we will see continuing this year?
Yeah, I think there's going to be still an increase in ton miles this year, both from the crude sector because of what we mentioned and these additional barrels being produced in the Americas and being transported to Asia, but potentially also on the clean side. Because of the new refineries which have been built over the last few years and which are being built in the Middle East and in Asia, a lot of them geared towards exports and taking market share from refineries, all the refineries in the U.S. Atlantic coast and in Europe. Which we have seen a period of soft refining margins recently, and so these older refineries are again suffering quite a lot, and they'll be producing at a lower utilization, and eventually some of them will be closed, as has already happened in the past with other refineries which were closed in these regions. And if consumption falls faster than this reduction in output at these locations, that creates more rooms for imports from these lower cost refining regions, and that's what I think we are going to be seeing going forward, which should continue contributing to ton miles. Now, one factor which could be negative from a ton mile perspective is the Dangote refinery. But partly that is already factored into the market because the Dangote is already producing quite a lot of refined products. It's going to be continue ramping up its production this year, which should reduce imports into that country. But it also does create more opportunities for exports out of Nigeria. They are producing refined products at a very high spec, which can be exported to Europe and to other countries which demand these high specs, and import the cheaper, lower specs produced by older refineries and earn a profit like that. So there is room for trading to occur and for Dangote actually to be beneficial for the market.
What does the market need to see to believe that the demand side here will stay strong on the product side?
Well, I think that everything is in place for the demand to be strong on the product side. I think that of course questions are asked when you see rates softening, but I think a lot of this relative weakness we saw in the second half of last year was linked to what happened in the summer, to the fact that important quantities of clean products were transported on crude tankers, and that created this overhang I referred to that needed to be digested. With the sanctions coming into force now, and there's room for more sanctions to be implemented by the US, Europe, and UK in the coming months, then there is a scope for the market to be even tighter. And something we haven't referred to also is sanctions on Iran. But that also can be quite meaningful, especially for the crude tankers, but for the reasons we mentioned, indirectly also for the product tanker sector. Iran was exporting around 1.7 million barrels per day of oil last year. But when Trump was last president, their exports were significantly lower and around 300,000 barrels per day. So there is a room for these exports to come down significantly. And I believe that Trump is going to be very tough on Iran, as he has been in the past. And that will create more room for U.S. shale oil to increase and gain market share, but also for other OPEC countries to gain market share, and for this oil to be transported on compliant vessels as opposed to sanctioned vessels. So it should also be very positive for the market.
We've seen a bit of a cool-off among shipping investors, and the arguments have been that the best years in tankers are behind us. The risk-reward is no longer as attractive. You agree with this kind of view? And can you help us here? Look at the big picture. Where are we in the cycle? What potential is left in this space?
No, we had 3 amazing years on the product tanker side, but there is room for for good markets going forward for a few years. It is true that quite a few vessels were ordered in the last few years. But it's also true that the delivery of these vessels is spread out over a number of years. So, and if we look at the order book for tankers as a whole, then we are talking of an order book of around 13.5%, both crude and products. And that seems quite manageable. So if we look at deliveries for next year across crude and products, they should represent around 3% on a deadweight ton basis of the vessels currently trading, which is possibly slightly higher than the increase in demand, but not much higher. So, and if we do add to the current market additional inefficiencies related to the sanctions we were just referring to, then there is actually the market could actually strengthen this year across tankers generally. Then, as we mentioned previously, the biggest improvement will probably be for the VLCCs, but a lot of that strength will flow through also to the other segments, including to product tankers.
Excellent. Could you share some rates expectations for 2025 on the product side?
No, I think that's difficult because there are so many geopolitical factors, at play currently. The base case is for a strong market. There are scenarios which can play out, which can lead to very strong markets, as strong as last year or even stronger. But of course, there are scenarios which can play out, which can lead to weaker markets, right? And if those scenarios materialize, then the safety cushion we have is demolitions, which have been minimal over the last few years, but the fleet has been aging very rapidly. So there's a lot of scope for demolitions to rebalance the market and then, bring us again to another up cycle which should not be too distant.
I looked at your last presentation and noted the lower debt service in 2025, and to what extent could this benefit shareholders?
Well, yeah, we have been working on that because we want to make the company as resilient as possible. You know, we are very conscious of the fact we work in an industry which is cyclical. There were very strong fundamentals as this upcycle started, and we were quite confident that this cycle was going to last quite a bit, as it has, and there's more to come. But we also know that eventually the market will correct, and therefore we want to be ready for that when it happens. And we have been lowering our P&L and cash break even, which means that, you know, when freight rates do come down, vessel values do come down, we will be in a very comfortable position to invest more and acquire tonnage on the cheap to then benefit from the next upcycle.
We talked about the fleet growth in last year, and if I'm not mistaken, I think you managed to grow the fleet without increasing your debt too much. And how did this affect shareholder returns?
Yeah, as I mentioned, I mean, we actually managed to improve our debt ratios. Ratio of net financial position to fleet market value is of just 6.2%. Was of 6.2% at the end of Q3 last year, and we did this despite investing 45 million for the first installments of the 4 LR1s we ordered, and another 62 million for the 2 MRs that we exercised and that were delivered to us last year. And so despite these use of funds, we were also able to distribute $60 million in dividends in 2024 calendar year, and purchase back shares worth 9.3 million euros. So I believe, you know, we were able to accommodate both generous shareholder returns and continue to invest for the future. Not to grow the fleet, because at this point in the cycle, our objective was not that of growing the fleet, but to continue controlling a modern, efficient fleet.
So your growth priority will be more reduced going forward.
Yeah, despite the vessels we ordered, you know, we don't see them as necessarily leading to a growth of the fleet, because we do have some older vessels in our fleet that we are going to be selling in the coming years. We sold one this year, the Glenda Melanie, and we have 3 other Glenda vessels, 2011 built, that we are going to be selling in the coming years, probably before we take delivery of the LR1. So we see going forward, you know, at this stage, quite a flat fleet of evolution. There might be a dip in the number of vessels controlled in 26 and the end of 25, but then the fleet should grow again, and by the end of 27 we should be more or less where we are today in terms of number of controlled vessels, around 33 vessels. So you know, we want to make sure we continue having a competitive modern fleet, and that's why we ordered these LR1s this year.
Have you considered more frequent dividends, for example, quarterly? And do you think that could be a way to draw investor attention to your company?
Yeah, we have had such comments in the past, investors which suggested we increase the dividend frequency to quarterly. Well, during many years we didn't pay any dividend. Then our usual practice was to pay it once a year, but to try and accommodate a bit the request, we decided to increase this frequency to twice a year. I must say we are quite happy with twice a year, and we don't want to pay a quarterly dividend. I think that we understand the logic of distributing more cash when markets are strong, and we understand why investors like that. But we also are quite conscious, as I mentioned, that we operate in a cyclical industry. Dividend is not something that you can always count on, and so we are not really a dividend play. We are happy to distribute, and we think it is the right thing to distribute more generous dividends when the markets are as strong as they are now, and we have a controlling shareholder who's also very happy to receive more dividends. So in that sense, their interest is aligned with that of the minority shareholders. But we are not going to be ever a regular dividend payer. It will depend on the moment in the cycle and on the outlook for the cycle. And it is important to retain flexibility to be able to move quickly and invest when things change. And so we have to balance these different priorities, and that's what we are trying to do with our capital allocation policy.
Last time we spoke, we talked about the fact that your company does not have a home country advantage, that you are not listed in the typical shipping countries or stock exchanges. And how does this stand right now? And can you tell us a bit about how d'Amico is valued compared to peers?
It is true. It is true that being listed in Milan, does pose us some additional challenges to gain visibility with investors. It is not the only factor which maybe hinders our valuation. I mean, we do have a controlling shareholder which has quite a big stake in the company. So if we exclude the treasury shares, they have 63% of the ordinary shares. So that does reduce a bit the free float available for trading, which negatively affects the liquidity of the shares. So particularly for large investors, which have to invest big amounts, that can be an issue. And we have to fight a bit harder to convince some Norwegian brokerage houses to cover our stocks, because we are not listed in Oslo or the US. But we did manage to convince Furley's and Pareto to cover our stock, and that has contributed to greater visibility with these investors. When the controlling shareholder sold some shares earlier in 2024, the large majority was sold to non-Italian investors, actually. UK, US, and Norwegian investors took the big chunk of the shares in that private placement. So we do have to work a bit harder, but we can get the right level of interest also from these investors. We are trading at a bigger discount than some of our peers to NAV. During brief periods in the past, this difference in discounts to NAV relative to our peers was smaller. It does fluctuate. If we look at where we are trading today relative to the NAV that we had as of 30th of September last year, we are at a 55% discount, which is a huge discount. But also our peers are at discounts today. So hopefully, this discount will fall as we show that the markets, the improving markets that we have seen over the last 10 days are sustainable, and we will do our best to make sure that this discount falls in absolute terms and also relative to our peers.
Excellent. Let's talk a bit about the upside potential in the company. Of course, the rates are an important element here, but also your fleet size. And you discussed a bit about the fleet, and you have bought some, but you're also selling some. So maybe we could look a bit on the upside potential for your companies in the coming years, and how attractive that makes you.
We still have a sizable fleet. We control 33 vessels. We currently actually don't have as much coverage as we would like to, for the reasons I mentioned. Although we are very bullish on the market, there are a number of geopolitical factors which have contributed to this very strong markets in which we don't control. So from a prudent perspective, if we can take a bit more coverage, we are happy to do so. If the rates that we can achieve on these contract periods, we feel are satisfactory and reflect the market strong underlying fundamentals. But we can do very well still in 25 and 26 if the markets are strong. If things don't turn out as we expect, we will also do quite well because of the contracts we have. I wouldn't say our base cases for the markets in 25 and 26 to be as strong as they were last year, but it is a possibility, and because there are some geopolitical factors at play which could even lead to stronger markets than we had last year. So it is we are going to be operating in a volatile environment, the markets can and will, I believe, move up and down quite a bit during the course of the year, as is usually the case for shipping and for product tankers. But our base case is that we are going to have very strong years in 25 and 26.